This is Neeraj. Thank you very much for joining us to the buyer webinar. So we have Ms. Zenith Merchant from National Bank, who's gonna be sharing giving us an insight about if you're a buyer and in this market, and what are you looking, and what are the things you should be considering. And if you are a first-time home buyer, you will have a lot of information regarding, hey, what is a mortgage and what is this, starting right from the ground, understanding what is a mortgage, so that you can understand the whole process from the banking perspective. Okay, so without any further ado, let's begin. We were waiting for Highness. Sorry about that. We had a little bit technical difficulty in the beginning, but anyways, sort it out. Anyways, welcome, Jinaji.
Hello, Neeraj. How are you?
I am
guys.
good.
How are you?
Good. How are you doing?
I'm good.
How's the COVID treating for the banking in terms of the mortgage?
I think COVID is actually helping the mortgage.
Yeah. Okay.
Yeah, it's actually helping the banks. People are more into buying the property right now. The properties are not as good as they wanted it to be.
Okay.
The market is not as good, so it's actually very hard for people buying the property. Yes, it is a seller's market.
Yeah.
Yes, it is no doubt a seller's market, but people are still in the market to buy the property. They still want to own the property since they are anticipating the values to go up further.
I 100% agree with you what you're saying, because right now people definitely need a place to live, that is for sure. But let's talk about our, starting right there. So I know you're saying, people, those who are on the Facebook or Instagram, you guys are not able to see our screen. However, if you are connected with us on the Zoom, and then obviously you'll be able to see our screen as well. But we're gonna start right, try to explain as much as possible. So what is a mortgage loan? So would you be able to show a little bit, what does that mean?
Mortgage is a loan that it's a financial institute that gives you a loan, that grants you a loan, which is a property which is an institution that the property serves as a collateral for the payment. So what happens is, when you buy a property, bank offers you a loan, and then bank put a collateral on your property, which is a debt, and you pay it off in a certain time of amortization, certain time period.
Okay.
And then after you've paid off that mortgage or the loan, then you are the owner of the property. Fully, you're the owner. Right now, you're co-owner with the bank.
Okay, all right, so that's fine. So which means, in other words, simply put, so you own okay, so the title is under your name, which is the property is under your name, but still somebody has interest in the property. That is the bank who actually invested in that.
Exactly. It's just like when we buy a car.
Yep.
And we take a finance on a car. The car we are driving, it's our property, but the lien owner is the financial institute, whoever is giving you the loan. It's something similar in that.
Okay, all right. So again, let's talk about going back. Let's talk about what is a newcomer. So now you had a question about a newcomer. So what is a newcomer?
A newcomer is a person or a family who comes into Canada, has moved to Canada very, very recently. They have a permanent residency or a temporary residency in less than 5 years. They are considered a newcomer to Canada.
Okay.
Most of the banks, especially National Bank, we have a newcomer program where we give them quite good incentive to be able to buy a property.
Okay, so
in terms of interest, in terms of and not only the banks, also the government allows them a lot of incentives when they buy a property. In terms of down payment, CMHC offers them. They can buy a house with as low as only 5% down, and they have a lot of other options that they can use when they are newcomers to Canada.
I know you just mentioned CMHC, but a lot of first-time home buyers do not know what the CMHC is all about. Are we talking about a little bit about CMHC later on too, or are we gonna take it?
We will talk about CMHC is Canadian Mortgage Housing Corporation.
Okay.
This is a government-owned regulatory company that they actually insure the banks on a high-risk mortgage. High risk means if you're paying lower down payment, so the risk is huge to the bank.
Sure, yeah, fair enough.
Right?
Because
so they protect the bank to say, God forbid, then they help the bank out if something goes on the wrong side. So what happens is they do charge a small, a premium on the mortgage. Okay, and if you're 5%, if you're paying 5%, I would go on the higher side. It would be about 4% that they would charge you
Okay.
on your mortgage amount, and then the bank is protected. You are actually paying, but you are protected more to say you would be paying off the bank and the future properly.
Okay, so if they want to put more than 5%, does that mean that their
The premium goes
reduce?
lower, yeah.
Okay, so
Yeah.
if you have any cushions, or if you're thinking about what you can buy, you can put it as low as 5%, and if you have a capacity to put more money, then obviously your premium will reduce, and hence you will save a little bit more money. And so obviously that definitely helps in buying the property. Okay, so now let's move on to the next. Okay, so I know you already spoke about what is a newcomer. Is anything else you want to add up into the newcomer?
In newcomer, there are two types of newcomer. One is a permanent resident that came on a PR card, and they actually came as a permanent resident in the country.
Okay.
And then there is temporary resident. Temporary resident means they have either come as a work permit or are on a refugee claimant.
Okay.
Correct?
Okay.
Temporary residents, there are a lot of restrictions when any banks are lending to temporary residents. They do have work permit, they can work in the country, but when it comes to lending, there are quite a bit of restrictions when it comes to down payment, when it comes to, they have to come with more money.
Okay.
As compared. But
so
permanent,
it's still possible.
Oh, yeah, it is possible,
Okay.
yes. But when it comes to a permanent residency, the information that I provided earlier, that they can go with lower down payment, and if they are in the country for less than 5 years, the income documents are also not as, or income, we do not require as such income for 2 years. They can also be working even 3 months in the country, and we can work out. They may have a lower income, their ratios on a debt may be a little bit higher, but we do help them out.
Okay, so which means the hope is still there, even if somebody is brand new, have a lesser, not such established credit in Canada, and plus, but the prerequisite, they still be working.
Yes.
Okay, so if you're working, if you have a little bit of money to put as a down payment, definitely you have a chance that you can still buy a property. Okay, so criteria that every client must meet. What is that? I mean,
the criteria is that they have arrived in the Canada in the past in between 5 years or less.
Okay.
Then they become a new. This is for the newcomer.
Okay, that's for the
That's
new.
a, yeah.
Okay.
Yeah. And I've worked full-time job in Canada for at least 3 months.
Okay.
Either it's a part-time or a full-time.
Even a part-time.
Yeah.
Okay. All right. Cool.
Right? And demonstrate a good payment history and ability to pay all their obligations. So when they come to the people, when they come to Canada, they'll have open bank accounts, credit cards. So when they have credit cards or car loan, we look at the credit history to see how they are paying. Okay. It may be new, but then we need to have a look at it. Yes.
Okay. All right. Okay. When you say eligible properties, what does that mean?
It means a property where you want to actually gonna live in, like a condos, mobile homes, properties, houses.
Okay. So you're looking like 1 to 4 units. So what does that mean? So if anything which is what does a 4 unit mean?
4 unit means it is a house that has 4 entrances, 4 like it's more like a 4 apartments in one building.
Okay,
In
more
one
like a
property.
quadplex.
Or quadplex, yeah.
Okay, quadplex. So which
Yeah.
means you actually eligible to buy a
Up to
duplex,
4 units, yeah.
triplex, or up to quadplex, which means actually 4 unit, which means you can rent in one and you can rent. So you live in one and you rent out 3.
The 3 others. Yes.
Okay,
Yeah.
so guess what? So in that way, you can actually have not only just for your primary residence, but you also have a little bit of what?
Yeah.
Investment.
Investment,
portion
yeah,
into
you
as
have
well.
both of them.
Now we're talking about investment. If somebody's going to buy a triplex or a quadplex, so in that way, how does the bank deal with in terms of the down payment? Is it still considered as a first-time home buyer?
If you're going to reside in one part of it, then it's considered, we can go with 5%, as low as 5% too.
Okay.
Yeah, but if it's only for rental purpose, purely for investment purpose,
Okay.
in this case, the 20% is minimum.
So that's another good news. So if
Yeah.
you are partially occupying like an owner occupied property, you can still go as little as 5% and you can still have your property. That's great news though, actually. All right, cool. So let's move on. Ineligible property. So we'll talk about second homes and
Second
all that.
homes and small size condos, these are all ineligible properties, because ineligible properties for a newcomer program. If they don't come under newcomer program.
Okay.
That's
All right.
different.
Okay. So What do you have, like, we're talking about the mortgages, so
Yeah, it's a convention. There are two types of mortgage. One would be conventional property, where people would be paying 20% or more.
okay,
Okay, that's a conventional.
okay,
The other, and the loan to value, it depends how much you want to pay, depending on your income and how you work, what you're doing. If you're employed and you're self-employed, you can go as low as, you can put down as low as 20%.
okay,
Okay, and if you are foreign income from US, or if you are temporary residents, as we spoke about, your down payment has to be 30%, 35% or higher.
35% or higher.
Yes.
Something to think about. I mean, by the way, guys, we are covering these things just for you can do your homework very well before you hit the market and say, oh, how I'm gonna get eligible to buy the mortgage. And certain these terms becomes like a norm, sort of, that you hear day in day out, and you don't know what does that mean. Like, what is the conventional mortgage? I mean, hopefully, these questions will be able to give you a little bit insight to it, so that so when you are actually in the market, so you know what exactly to do, and you hit bank right on.
Hear the words high risk, conventional. These are the two information you normally come across. High risk, conventional. Conventional is when you put more down payment, and CMHC, the government regulatory body, or what you call it, the insurer is not involved.
Okay.
In that case, it becomes conventional. The moment the insurer is involved, like CMHC or Genworth, then it becomes high risk.
So Genworth is also
another company.
Is it also a government company?
They're all, yeah.
Okay. Yeah. So okay, all right, cool. Now the criteria, what you're talking about.
For a newcomer, the maximum financing is up to $1 million.
Okay.
Maximum.
But that is again up to depending upon the eligibility, income criteria.
Income criteria, but income criteria, everything is there. Criteria is there. The thing is, they cannot get a mortgage of more than $1 million. Not that they can buy a property of up to $1 million.
Okay.
Right? If they buy for something for 1.2 million, the rest has to come out of pocket.
Okay. All right. Cool. So at least a $201 at least has to come from your pocket, right?
Yes.
200,000, 200 plus $001. Anyway,
Exactly.
You know the math, right? What
Yes,
I mean?
and then the property gets fully appraised by the appraisal companies.
Okay.
Each bank has their own criteria or own companies that they deal with.
Yeah.
They are all professional people. They do the property appraisal based on lending guidelines.
All right.
The appraisal on the property, this is one of the things that people have a misconception that my property, let's say that's what normally what people are saying, oh, my property is worth 1.5 million and your appraisal said it's 1.2. What we don't understand, not what you can sell the property for. The appraisal that the banks do are under lending guidelines.
Okay.
So it's not that what you can sell the property for. You can maybe sell the property for 1.5 million, but the appraisal came at 1.2 million because what they look at how when the bank is lending. So this is the criteria what they use. They have their own numbers how they follow, and that's how they give you the value of the property.
So does that mean that let's say if I'm going in the market today and buy a property for worth $900,000, if I can find a good detached home right here in Toronto, which is very doubtful. But anyways, let's say if I'll go and find something in the suburbs and I find a $900,000 property, possible that it's the appraised value came like 850, 875.
Let's suppose if it comes 850, you would be getting mortgage based on 850.
Okay.
The balance of 950 either comes out of your pocket, or if you have financing condition, you can say, sorry, I'm not buying this property.
Okay, so then your financing is not approved.
Yeah, but but if you didn't just waive off all the condition, then this 50,000 is coming out. Extra 50,000 is coming out of your pocket.
Okay, so by the way, especially in today, we are talking about in April 2021. Today's market is as we mentioned earlier, this is a high sellers market. I mean, you have to do your homework very well. I mean, this is the reason why we are actually talking today. You have to do your reason very homework very good. Why? Because in today's market, if you go and put sometimes if you put in a conditional offer, it may not even get accepted. It's very highly possible. I'm not saying it's happening 100% of the time, but it is possible.
That's what we call a seller's market. Correct?
It is again, yeah, that's it, a heavy seller's market. So it's so we have to be a little bit mindful when we do anything. Anyway, so with that, so I guess from the mortgage perspective, I guess we are done on that side. But let me ask you a question on from the side of, if somebody is a let's say not a first-time home buyer, but a person is a what do you call it? Investor. So how would you recommend, if I already own 2 properties and I wanted to buy a third one, what would you guide them?
If you're buying a third property, it mainly goes by your income actually.
Okay.
We use the income from the rental property, but not 100%.
Okay.
Plus, we deduct the information, we deduct the current mortgage off it, and deduct our expenses of the property that you have already as a rental.
Okay.
You already have your own owner-occupied property,
right?
So that is, again, if there's a mortgage, there's no more. All of this depends if you fall into the criteria and your debts are under the ratios.
Okay.
That should be debt to income. It should be gross debt would be about 40% or less.
Okay, so you says ratios, debt. Can you tell the listeners what does that mean? I mean, give it a basic.
Income to expense ratio.
Okay, so can you give an example?
They actually include your income, your housing where you're living already, your property that you already own, that is your rental,
okay,
and the current property that you're buying.
Okay.
Plus, if you have any other debts, your car loan, your credit cards, your line of credits, the payments on that is used on the as a mortgage, and then they use it.
Okay.
That's what it is.
Okay, cool. Okay. So so they still have to qualify based on their income. But when it comes to the rental, I also heard, I mean, you can either clarify it. This is, you can take a 50% of that income can be added into your personal income to qualify. Is that correct?
Yes, you can use 50%,
okay,
minus the expense of the property.
All right, guys. So you have to keep that in mind if you are an investor, that certain things you gotta be, considering that it's still based on your income, and obviously a good credit is required, right?
It's declared income.
Or declared income. Okay, so that's anyways, guys, this is the basic information about the mortgage, and from especially for the buyers. This is a quick webinar we did it just to give you basic information what you need if you are in the market looking for the property. I mean, this is again from the bank perspective, but when it comes to buying the property, there is a process on the real estate side as well. Okay, in that real estate side, I will not gonna go and dump a lot of things in there, but however, I will still look at through, like, they're like 6-7 steps. I will still go through it, and the number 1 step, which is the most important, is to go through the mortgage. This is which we covered today. Okay, rest of the things are again buying the property. When you're looking at what kind of a property is in the market and what can you qualify for, based on that you will look into the market, as a specific market that is also based on your needs, what you want, where do you want it. Are you looking for a good school district, or are you looking for maybe you're a city person and you want to live a lot of things to be done in town, and like you want like things are happening around you, or you're looking for a dog park, or maybe you're looking for maybe a property where you can go and drive by, and get to the countryside quickly. I mean, that is also possible. So you gotta look at your needs and wants, and then after that we'll search out the property. I can talk about that, but again, definitely if you have more questions, you can always contact me. My contact information is below this slide. Actually, that's what I'm keeping it here. If you have any question, you can definitely reach out to me, no problem. We can matter of fact, I can go in details with you on what to do, and then again, how's the market doing, and what are your what your target is, what you're looking to do. We can definitely talk about that. But anyways, guys, thank you very much for joining us today. I look forward to speaking with you again. If you guys have any question, leave us a comment, or call us, email us. We'll be more than happy to discuss it with you. By the way, my phone number is 647-282-8078. I'm going to repeat, 647-282-8078. And Zeenat, would you like
Mine is, yes, 416-399-1985. The number again is 416-399-1985. Also, guys, if you ever want to know more about different kind of lending, different kind of properties that you're buying, you want us to discuss something more, another sort of a webinar you want us to do, please let us know that too.
Sure, absolutely. And if you have anything specific, as this is more personal to you, we're more than happy to provide you that information. Well, anyways, thank you very much for joining us today. Have a fantastic Sunday, and we'll enjoy. Bye-bye. Have a good one.